The earnings season in Nigeria has unveiled a stark contrast between the fortunes of the banking sector and the manufacturing industries, particularly the producers of consumer goods. While listed banks are declaring impressive performance in terms of profits, the manufacturer seems to be grappling with significant losses. According to some analysts, this divergence in performance between the financial and manufacturing sector pictures the underlying dynamics shaping the markets and the broader trends influencing consumer behavior. Let's get talking this afternoon, and I'm being joined by Portfolio Manager, AfriInvest West Africa, Mr. Babajide Atolagbe. Mr. Atolagbe, good afternoon, and thank you so much for your time. It's good to have you on the program.
Thank you. Good afternoon. The pleasure is mine.
Let me start with asking you, where really is the cycle of the stock market at this time?
Okay, for the Nigerian stock market, really I can see that we are gradually coming off the highs, the 2024 highs, and I'm speaking in respect to the returns that the market had, reported in the first quarter of the year. And I must say that in the first quarter of the year, the market had reported return in excess of 30%, right? And that 30% has been largely, driven by, investors' expectation about, certain companies in the Nigerian Stock Exchange, particularly the activities of the banks, right? The return has also been the back of anticipated increase in, the profitability of some, bellwether, companies in Nigeria, particularly the banks, because of the events that has been shaping the FX market of late, right? But in April, we've seen the market take a different trajectory, and losses that has been, gains that has been accrued for the most part of the year are starting to, stocks are starting to shed some points. And when we investigate into why those stocks are losing value, the critical underlying, driver of the losses has been the policies that has been taken by, the federal government or the Central Bank of Nigeria. And speaking in particularly to the banking sector, I must remind us that, the FX devaluation that happened late 2023 brought about an inflated, profitability for the banks, right? And in order to, curb those excesses and also to ensure that the banking sector is prudent in spending, the CBN came out with a circular to say that banks cannot, necessarily use those returns, use those monies reported from FX gains to, to pay dividends. They can't use it to take up unnecessary operating expense. And they also said it cannot qualify for, capital purpose. So all those policies, simply, investors are interpreting those policies as, okay, profit has been strong, but this profit cannot be translated into gains for investors in terms of cash dividends, or, cannot qualify for capital purposes. So this sentiment has really, really dampened investors' perception of banking stocks. And that has really, really accounted for a significant decline in prices of the stock, the sector, and overall equity market performance in Nigeria.
A good way to start now, before we now look at what is happening, the banks continue to declare profit. As we see that the exchange, and of course, their stockbrokers are smiling to the bank. They are all happy about that because, of course, dividends coming in one way or the other. But on the other side, we see the consumer goods, particularly that's in the manufacturing space. They are the ones receiving that bashing. What is your understanding of this, and how do we balance things up?
Well, I think it's a sector dynamic, right? If you look at both the banking sector and the consumer goods sector, or let me say the manufacturing sector at large, right? They have different dynamics shaping, the performance and, profitability of both sectors. I must, however, say that the manufacturing sector is currently at the receiving end of the recent policies that are being taken by the Central Bank of Nigeria, and speaking largely of the FX reformations, as well as the increase in policy rate, right? Let's break it down a bit, right? For the banking space, you will see that they've been reporting higher income and higher what you call profit. And the manufacturing guys, although their revenue is stable despite dwindling or weakening consumer purchasing power, their gross margins are relatively stable as well, despite the fact that they are experiencing some disruptions from the supply side due to global and domestic factors. But the real challenge comes from after their gross profit, right? Looking specifically at their FX adjusted losses. So the banking sector, I think they enjoy largely from the policy because they create foreign currency assets, and as a result, due to the devaluation, they tend to enjoy foreign currency gains, because when a bank creates loans in foreign currency in dollars and there's been an appreciation, the return on the FX return also amplifies the entire naira return. So that's what is responsible for the increase in bottom line of the banking industry. But if you look at the manufacturing guys, particularly the consumer goods, right, the reverse has actually been the case, and that is because rather than having dollar-denominated assets, stocks, or let me say companies in this space, have dollar-denominated liabilities, right? And those dollar-denominated liabilities, are taken to finance their sourcing, channels, and also to ensure that they have the necessary supply for processing. So we see that the policy has changed. The naira is now reflecting market forces, and the naira has changed from the historic sub 1,000, now trading at around 1,003, 1,004. Manufacturers are now forced to bear the mark-to-market losses of those of the FX liabilities, and as a result, they tend to suffer from that. And you will say that both sectors have good top lines. I even give a credit to the manufacturing sector, because despite the serious inflation and the serious devaluation in consumer purchasing power, the revenue for most manufacturing companies is still relatively good, and that speaks to the resilience of that sector, right? The ability of manufacturing companies to actually be flexible on their sales channels. But the real issue starts from the obligations they have in foreign currency, and that has been the major the major divergence between manufacturing and the banking sector. The banking guys are smiling because it's quite in their favor, and the manufacturing guys are not particularly excited due to the losses they're recording.
So if I'm to ask you that, what really does the FX situation now mean for different groups or different segments of the economy?
Well, I think those who will continue to smile to the bank will be those who really create, dollar-denominated assets, right? I mean, that is solely on the assumption that the naira would continue to depreciate, right? But let's keep it at this. Whichever way the market goes, those who create foreign currency assets are exposed to volatility, right? And in the same way, those who have foreign currency liability are also exposed to the volatility. For example, if the naira continues to depreciate, the value of foreign currency assets begins to inflate as well, right? And on the other hand, if the naira continues to depreciate or appreciate, the value of the foreign currency liability also expands. So I would think that different sectors have different portion of the pie because of the structural dynamics of the sector, right? If you are dependent on foreign currency liability to finance your working capital or to push capital projects forward, the current FX situation does not necessarily support your operations because of the mark-to-market losses that you might experience. And on the other hand, if you're creating dollar-denominated assets, you're exposed to recording gains on the back of the slight depreciation in the naira we've been saying. So it depends on what side of the table you're sitting.
You sit. But I would always like to ask this question, particularly when I'm talking relates Forex, and that's been on the front burner for some time now. A day hardly passes without mentioning the FX issue. Do you think that our currency at the moment is appropriately priced? That argument has been on for some time, saying that even after opening up the market, which is supposed to help attract the expected investment into our markets, are we getting that level of confidence that is expected? That's like a two-in-one question.
Well, in terms of the currency being adequately priced, at the moment, we cannot necessarily tell if the currency is adequately priced because there are different, models that are, giving us different values, right? And don't also forget, the pricing of currency is not just dependent on, whatever the model says. It's also dependent on the fact that the market has the adequate structure for the market to operate a willing buyer and a willing seller, right? But what we can confidently say is that based on the policy reform that has been taken by the central bank, we are navigating towards a market that can help us, price the currency adequately, okay? Whereby we have a uniform market and we have investors coming to, investors coming to buy and investors coming to sell, or anybody coming to buy and anybody coming to sell. That kind of environment can create an opportunity for price discovery. So we're currently on that path, at least based on what the CBN has communicated. And on the second question of whether we're able to attract foreign flows into the country, I would think that for foreign flows, we need to dissect it into two perspectives. That is foreign portfolio investment and foreign direct investment. Over the years, foreign portfolio investment has been the inflow. The foreign portfolio investment actually contributed significantly than foreign direct investment, right? Although both of them are on a declining trend since 2018. But lately we've seen that the policy tightening by the central bank has supported foreign portfolio investment, particularly in the first quarter of the year, as the bank and the central bank was able to get inflow from the NTB and some OMO issuances, right? I think if we continue on that trend, that might continue. But again, it now begs the question of if the system is expensive, issuances over the next, foreseeable quarter, right? And for the foreign direct investment, that has been relatively slow, and that is underpinned by the infrastructure deficit, the macro challenges that we have in Nigeria, right? And the CBN can only do so much in making that picture better. I think the entire responsibility falls on both the CBN and the federal government. So I think if they continue to harmonize plans and continue to show investors that, okay, we are ready for business and we're ready to operate a market reflective a market, we might see a substantial or an ideal increase in foreign portfolio and foreign direct investments in Nigeria over the next couple of quarters.
With the efforts by the Apex Bank, of course, to address backlog of FX commitments and all of that, we see that we saw a bit of shift. That's talking about the rate from the naira to the dollar. Now, many analysts have commended the central bank so far, looking at some of the moves they made, even sorting out the aviation guys and all of it. What's your take with regards to that? Do you also think that we are on the right track as regard monetary policy? So we know that what we expect is the complementing that on the side of the fiscal side. Are you also on that? Do you believe this?
Well, overall, I would say we've made an improvement from where we used to be in terms of how vibrant or how consistent the central bank has been in terms of its monetary policy direction, right? That's we give credit to the central bank, okay? And in terms of their policies and their directions in the FX markets, I think we also give credit to that, given the fact that they've been able to engage both local and international participants about their informations and the plans that they hope to achieve, right? But on the inflation point of view, right, we still think there's still a lot to do there, because if you look at the manufacturing sector, for an example, you will see that the sector in itself is challenged by so many inflation-driven factor, right? Inflation from both the development outside the country, which is global supply inflation, and also inflation from domestic happenings, right? The sector is already challenged with high inflation, and as a result, you see that their margins are quite slim. And this particular sector, they are now operating in an environment where you have high interest rates, okay? High interest rate is not in any way so good for them. We've seen commercial papers out at 22, 23, and in some cases 24% in just about 274 days or 360 days. That's a lot of money, right? That's a lot of cost for the manufacturers. So manufacturers are grappling with supply chain issues, and they are still also grappling with the fact that the cost of access to capital is relatively high, right? So that in any way is another disincentive for the manufacturers. So while we think that the interest rate adjustment upward will help in curbing the excess liquidity in the system, we think that the short to medium-term impact will be largely felt by the manufacturing sector. And don't forget, the manufacturing sector is that sector that we really, really need to drive the type of inclusive growth that we need for the country.
I must thank you so much, Mr. Babajide Atolagbe, Portfolio Manager, AfriInvest West Africa. Thank you for making sense of this topic of discuss. Do enjoy your weekend.
Thank you.
All right, they're coming up on the show, just like what Mr.